So kicking off into 2013, we had a rather significant change in the environment for taxing capital gains. So for a better part of 20 or 30 years now, we've had basically a two-bracket system. There was an upper rate that almost everybody paid. It was 20% for a while and then 15. And then we had a lower rate for people in the bottom bracket or two that was 10, then 5, then 0. But certainly most people working with moderately affluent to high net worth clients, there was one rate. It's been 15 for 7 or 8 years now, and that was it. That changed last year. We actually had two different changes that went through. The introduction of a new 3.8% Medicare surtax on investment income, which includes capital gains, and a new top capital gains rate of 20%. And so when we put all of that together, we have this new environment where there really aren't two capital gains rates anymore. There are four: 0, 15, 18.8 because you've got the Medicare surtax, and 23.8 because you're subject to all of it on top of each other. And then if you've got state taxes, you add it on top of that. Now the challenge that creates is when you get into a four-bracket environment, the traditional strategy of let's just harvest losses and push the gains down the road doesn't work so well anymore. When there was one top rate, it was pretty straightforward. Whether you had 50,000 or 150,000 or $500,000 or 10 million of gains, it was all the same rate, so you may as well just wait as long as you can. When we get four rates, it creates a very distinct problem. If you do too good of a job pushing the gains down the road, you make the gains so big, you actually pay more in taxes and finish with less money. And so that's beginning to really change some of the popular strategies out there, the most common one being good old capital loss harvesting. So if I got something, I sell it, I buy it back again, I claim my loss, I have to deal with the 30-day wash sale rules, but I get to claim a loss. The challenge to that is if I claim these losses and I do it too effectively, every time I harvest a loss, I bring my cost basis lower, which means my future gains are bigger. Well, if I do this too effectively, I start harvesting losses at 15 and I create so many gains that when I have to pay them back in the future, I harvest at 15 and I pay at 23.8 and I actually start blowing up pieces of client wealth in a non-trivial manner. And so what we're seeing now, the big shift in the environment, is that it becomes much more sensitive to client tax rates. If they're at upper income levels, you harvest the losses, take the loss at the biggest deduction you can. But for clients that actually have lower income years, the ideal thing is not to harvest the losses, it's actually to harvest the gains. So we sell the investments that are up and buy them back again. We pay the taxes now, but at 15%, that's good news if we're avoiding 23.8 down the road. And the process, we step up our cost basis so we don't have to deal with this problem in the future. And the good news is harvesting gains is a lot easier than harvesting losses. Congress doesn't have a rule, oh, you sold the investment, but since you bought it again, you don't have to send us the tax dollars. Once you sell it, you owe the taxes, but in this case, it's actually a good deal. And so we're seeing a much more year-by-year focus now for clients. If it's a high-income year, harvest the losses. If it's a low-income year, harvest the gains.